Hi everyone. Next, I'm going to explain about insurance. Life is full of uncertainties. The chances of occurrence of an event causing losses are quite uncertain. There are risks of death and disability for human life, fire and burglary risk for property, perils of the sea for shipment of goods and so on. If any of these takes place, the individuals and or organizations may suffer a great loss, sometimes beyond their capacities to bear the same. It is to minimize the impact of such uncertainties that there is a need for insurance. Investment in factory buildings or heavy equipments or other assets is not possible unless there is arrangement for covering the risk with the help of insurance. Keeping this in mind, people facing common risks come under together and make small contributions to a common fund, which helps to spread the loss cost to an individual by a particular risk over a number of persons who are exposed to it. Insurance is thus a device by which the loss likely to be caused by an uncertain event is spread over a number of persons who are exposed to it and who prepare to insure themselves against such an event. It is a contract or agreement under which one party agrees in return for a consideration to pay an agreed amount of money to another party to make a loss, damage or injury to something of value in which the insured has a pecuniary interest as a result of some uncertain event. The agreement or contract is put in writing and is known as policy. The person whose risk is insured is called insured, and the firm which insures the risk of loss is known as insurer, assurance, or underwriter. Fundamental principles of insurance. The basic principle of insurance is that an individual or a business concern chooses to spend a definitely known sum in place of a possible huge amount involved in an indefinite future loss. Thus, insurance is the substitution of a small periodic payment for a risk of large possible loss. The loss of risk still remains, but the loss is spread over a large number of policyholders exposed to the same risk. The premium paid by them are pooled out of which the loss sustained by any policyholder is compensated. Thus, risks are shared with others. From the analysis of past events, the insurer knows the probable losses caused by each type of risk covered by insurance. Insurance, therefore, is a form of risk management primarily used to safeguard against the risk of potential financial loss. Ideally, insurance is defined as the equitable transfer of the risk of a potential loss from one entity to another in exchange for reasonable fee. Insurance company, therefore, is an association, corporation, or an organization engaged in the business of paying all legitimate claims that may arise in exchange fee known as premium. Insurance is a social service in which group of individuals insure transfers risk to another party in order to combine loss experience, which provides for payment of losses from funds contributed by all members. Insurance is meant to protect the insured against uncertain events which may cause disadvantages to him. So, the Indian economy is classified in three sectors: agriculture and allied, industry and service. The service sector is the large sector of India. The gross value added at current prices for the service sector is estimated at 73.79 lakh crore international rupees in 2016 and 17. The service sector accounts for 53.66% of India's total GVA is around of 23.82 lakh crore international rupees. At 2112 prices, the composition of agriculture and allied industry and service sector are 15.11%, 31.12% and 53.77% respectively.